I'm Professor Indra Abeysekera. Let's look at hedge accounting forward contracts. Here we will look at with fair value measurement. The way it works is that we got a hedge item and a hedge instrument. The hedge item is being measured at spot rate. So there could be a, a receivable amount. If it is a receivable amount, at the end of the period, we are going to get a cash. But during that time, due to, for example, if this receivable amount is in foreign currency, this foreign currency will fluctuate. And as a result, the receivable amount at the end would be different from what's at the beginning. So but it's measured at the spot rate at that given time. That's the rate, that's the spot rate. But it applies to a payable as well. Payable amount is the cash to be paid now versus cash to be paid at the settlement, but that will change if this is denominated in foreign currency. And whenever we want to measure, we measure the hedge item at the spot rate. When it comes to the hedge instrument, which is measured at forward rate, when we enter into a hedge agreement like forward rate, we agree to settle the contract at a settlement date which is in the future. So that future rate is what is applicable here. So the future rate is a forward rate at settlement. And whenever we measure the hedge instrument at a given time, we measure that in relation to the settlement date. For example, when we enter into the contract, at that time, at the forward contract, the value of the forward contract is zero because it's a future settlement date, a future contract to be settled. So right now, there's no value. So it's zero. But as time passes, the forward rate keeps changing, and the forward rate and the settlement rate is fixed because it's been pre-agreed. The difference between the forward rate at a given time versus the settlement rate will determine the change. That is, the change could be a loss or a gain, but it's in relation to the forward rate. Let's look at another example. In this instance, ABC is an oil extraction company, wants to hedge the price of oil fluctuation. On 1st of July, company takes a forward contract. And this forward contract is indexed to the market price of oil, and the contract is to be settled in a year's time on 30th of June in the following year. 31st of December, on 31st of December, the fair value of the oil contract decreased. Before we generalize, let's look at these two sets of transactions. One is for the hedge item, the other one is for the hedge instrument. Hedge item here is the inventory, and hedge instrument is the forward contract. On 1st of July, we got no additional information about the inventory, and the change in spot rate is zero because we just started recording them. And for the forward contract was entered on that date for a future settlement date, so the change in forward rate is zero. 31st December, for the hedge item, now the spot rate has changed from 1st of July to 31st December. We need to change the value in relation to the spot rate in relation to inventory. So we need to record the change in value of the inventory because of the spot rate change from before to now. When it comes to forward contract, the forward rate also has changed in relation to the settlement rate. We need to record the forward rate now and the settlement rate, and that change in value would be recorded on 31st December. When it comes to the settlement date, that's 1 year after 30th of June, we need to journalize the spot rate now and the spot rate before, that's 31st December. And in relation to the inventory, we need to record the change in the value of the inventory. And then also, we also need to record the, the settlement of the item contract, that is the inventory sale. We need to record if we have that information. On 30th of June, for the instrument, we need to record the forward rate now and the forward rate at the settlement date. And that change in value we need to record. And we also need to generalize the closing of the hedge contract with the net of the cash, either to settle, to pay cash, or to receive cash. So let's look at the journal entries with the information that's given to us. For the hedge item, on 1st of July, the contract began and there was no change in the spot rate, and we have not got information about the sale value. We do nothing. On 31st December, there was a loss. We've been told there's a loss on the inventory of 40,000 because of the exchange, and therefore the inventory value has dropped by 40,000. 30th of June, we are given additional information that the inventory has gained in value by 10,000 from 31st December to 30th of June, and the inventory value has increased by 10,000, and there's a gain on inventory of 10,000. When it comes to the forward contract of 1st of July, the contract began and we record nothing there. 31st December, we've been given information that the forward contract has appreciated in value by 42,000, and we record a hedge gain. And 30th of June, the forward contract has depreciated in value in relation to the settlement rate, and we record a loss of 11,000, and the forward contract asset has now decreased by 11,000. The forward contract asset on 31st December was 42,000, and that value dropped by 11,000 on 30th of June, and the net value is 31,000, and that's the settlement date, and the forward contract is now settled, which is now an asset. It's been settled with the bank by receiving 31,000. on 30th of June, the fair value of inventory increased, but the fair value of the hedge contract decreased. So let's look at the journal entries.